Did you know that right now on YouTube, advertisers will literally pay up to $50 per thousand views just to reach people who are watching personal finance content? To put that into perspective, if you're watching a gaming or entertainment video, advertisers might only pay $2 to $4. So why the massive gap? Well, it's because financial institutions know something absolutely crucial. A single customer who masters their money is worth thousands, sometimes tens of thousands of dollars over a lifetime. This proves that mastering your own financial knowledge isn't just a good idea, it is incredibly valuable. Welcome to this explainer, where we are going to unlock that exact value for you today.
Here's a quick look at our roadmap. We're breaking down personal finance into a few key areas, starting with managing your income, moving into budgeting and debt, unlocking a really cool mathematical secret called the 7% rule, and finally wrapping up with investing and protection.
Section 1. The Personal Finance Playbook. I want you to think of personal finance not as some boring chore, but as the ultimate strategy guide for your life. It's really just the process of mapping out exactly how you generate, spend, save, invest, and protect your money. And hey, remember that $50 figure we just talked about? In the advertising world, that's called CPM, or cost per mil. Big financial services and credit card companies pay these insane premium rates because they know the math. They know that if you understand how to navigate their financial products, your lifetime value to them skyrockets. But the whole goal of this explainer is to give that power right back to you. We want you to be the one profiting from your financial playbook, not just the big banks. Section 2. Managing income and saving. All right, the first pillar of our playbook is all about managing your income so you can actually maximize what you get to keep. Because let's be real, it's not just about what you make, it's about what you take home. Now, one of the most misunderstood concepts out there is marginal tax brackets. So many people think, oh no, if I get a raise and bump into a higher tax bracket, all of my income gets taxed at that new higher rate. Nope, that is entirely false. It helps to think of tax brackets like a series of pockets. Your first pocket holds a certain amount of your money completely tax-free. Awesome, right? But once that pocket is full, the next chunk of your money spills over into the 10% pocket. When that one's full, the rest spills into the 12% pocket, and so on. The big takeaway here is that if you get a raise, only the new money going into the new pocket gets taxed at that higher rate. The rest of your money is totally safe in those lower pockets. Now, to keep your hard-earned money out of Uncle Sam's higher tax pockets, you need shelters. And two of your absolute best tools for this are the 401k and the IRA. A 401k is set up by your employer. It lets you tuck money away before it's even taxed. And a lot of times it comes with a company match. Listen, a match is literally free money. Do not leave it on the table. An IRA, on the other hand, stands for Individual Retirement Account. You set this one up yourself. It also gives you great tax advantages, but usually comes with a much wider menu of things you can invest in. Using one, or hey, ideally both of these, is going to drastically reduce your taxable income today while quietly building up your wealth for tomorrow. Section 3. Budgeting and debt control. So now that we're keeping more of our money, we have to structure how we spend it so we don't fall into the massive traps of modern finance. If budgeting makes you want to pull your hair out, you're going to love the 50-30-20 rule. It is a remarkably clear framework. Here's how it works. You allocate 50% of your income to absolute needs. We're talking rent, utilities, groceries, the essentials. Then 30% goes to your wants, eating out, movies, those streaming subscriptions. And then a strict 20% is locked in for savings, investing, and paying down your debt. It's just a really simple, elegant way to make sure you're enjoying life today while actively protecting your future. And sticking strictly to that 20% for debt and savings is absolutely crucial, especially when you hear this next statistic. Americans right now collectively carry over $1 trillion in credit card debt. $1 trillion. And guys, this is not cheap debt. The average annual percentage rate, your APR, on these cards is hovering at over 19%. Look, when you're trapped in high-interest debt and you're only making those minimum monthly payments, it is exactly like walking up a down escalator. Every single step you take is your minimum payment, but that 19% interest rate, that's the escalator pulling you continuously backwards. You are sweating, you are stepping, but you are barely getting anywhere. Honestly, if you only pay the minimums, you could be stuck on that escalator for a decade. And make no mistake, that is by design. Credit card companies profit massively when you stay on their ride. So, how do we finally get off the escalator? Well, you need a highly targeted strategy. Step 1 is just getting organized. You have to list out all your debts, either from smallest to largest balance or by the interest rate, so you can lock in your focus. Once you're organized, you've got two main ways to attack this, and people debate these all the time: the snowball method and the avalanche method. The snowball method says, hey, pay off your small debt balances first, completely ignoring the interest rates. Why? Because knocking out a whole debt gives you a huge psychological win. It's a dopamine hit that keeps you motivated to keep going. The avalanche method, on the flip side, says you need to tackle the debt with the highest interest rate first. Now, mathematically speaking, avalanche will save you the most money over time, but honestly, the snowball method often helps people build the actual behavioral momentum they need to cross the finish line. Just pick the one that fits how your brain works. Section 4, the 7% rule. Okay, pay attention because this rule right here is the absolute fulcrum of our entire explainer. It solves the biggest dilemma you'll face when you suddenly have a little extra cash. Do you pay off your debt or do you start investing? The answer is the 7% rule. This rule dictates that if the interest rate on your debt is above 7%, you need to aggressively pay it off. But if your debt interest is below 7%, you just pay the minimums and prioritize investing your extra cash. So why 7% exactly? Well, historically, the S&P 500, which is an index of the 500 largest U.S. companies, has returned an average of about 7% per year after adjusting for inflation. That makes 7% the perfect mathematical tipping point for growing your net worth. Let's look at a side-by-side scenario to make the math crystal clear. Let's say you've got a student loan sitting at a 5% interest rate. Because 5% is lower than the 7% you could likely earn in the stock market, your money is actually working harder for you if you invest it. But now look at a car loan at 13%, or worse, a credit card at 20%. Guys, there is virtually no safe investment on earth that will guarantee you a 20% return. If you try to invest while holding on to a 20% credit card balance, the math is actively working against you. You absolutely must ruthlessly eliminate that high-interest debt first. Section 5. Investing and protection. Once you find yourself on the right side of the 7% rule, it's time to make your money grow over the long haul, while simultaneously building a fortress to protect it. Albert Einstein supposedly called compound interest the eighth wonder of the world, and it really is. Think of compound interest as the snowball effect, but in a good way. It's earning interest on your original money and then earning interest on that interest. Over the span of a few decades, this multiplying effect grows your wealth exponentially, and you don't even have to add a single extra dollar of your own labor. Time is the magical active ingredient here. And if you want a really neat mental math trick to see exactly how fast that compound interest snowball is rolling, use the rule of 72. All you do is divide the number 72 by your expected annual interest rate. Whatever number you get is roughly how many years it will take for your money to completely double. So if you're getting a 7% return in the market, 72 divided by 7 is just over 10. That means your invested money is going to double roughly every 10 years, just by you leaving it entirely alone. How cool is that? But that begs the question, what exactly should you be investing in? The most crucial difference to understand is between individual stocks and index funds. Buying an individual stock is buying a tiny slice of one single company. If they crush it, you do great. But if they go bankrupt, you could lose everything. It is high risk. An index fund, on the other hand, is like buying a massive basket that holds hundreds of stocks all at once. By buying that one basket, you instantly spread out your risk. If one company in the basket fails, the hundreds of others hold your portfolio up. For most people, it really is the ultimate tool for passive, diversified growth. Now, if you are absolutely adamant about picking your own individual stocks, there is another 7% rule you need to keep in your back pocket. Legendary investor William O'Neill popularized a really strict risk management strategy. If an individual stock you buy drops 7% below the price you paid for it, you sell it immediately. No emotions, no praying for a bounce back. You just cut your losses quickly to fiercely protect your capital, so you live to invest another day. And speaking of protecting your capital, that doesn't stop at the stock market. You need structural protection in your everyday life. Here are the non-negotiable pillars. First, you absolutely must have an emergency fund of 3 to 6 months of living expenses sitting safely in a basic savings account. Next, you need proper health, life, and disability insurance. And finally, you need basic estate planning, like a will. Without these pillars in place, a sudden medical emergency, a car accident, or a job loss could force you to drain your investments and wipe out all the wealth you just spent years building. Don't let that happen. So we come to the final and really the most important question of this entire explainer. Are you going to let compound interest work for you or against you? Look, the math is completely impartial. If you carry debt above 7%, the math is slowly sinking you. But if you eliminate that debt and start investing, the math will slowly make you wealthy. The playbook is officially in your hands now. Apply the 7% rule today, get off that down escalator, and take immediate control of your financial future.